Everybody, this is Austin with the Jones Realty Group. I am visiting with some friends of mine. This is Jennifer Kilmer and Justin Carpenter from DJ Jordan Properties. Hey, everybody. Glad y'all are here. Hey, I want to start with Justin. I want you to tell us a little bit about DJ Jordan Properties. We have a lot of investors that are looking to buy houses, flip them, rehab them, flip them, make a profit off of them. A couple other people, many other investors are looking to buy, rehab, rent them out. And some investors are just looking for properties that have already been rehabbed so that they can buy and hold. Can you tell us a little bit about what you're doing to serve these clients at this time?
Sure can. So what we do? We're a hard money lender. We are collateral based with our approvals, therefore not not sensitive to credit history, income, or employment verification. On the qualifying end, the heaviest part of the underwriting goes to the underlying asset itself. The value of that house is what's being used to secure the loan. We lend a percentage of the purchase price as well as most of the rehab budget for these projects that require repair. We are lending, as deal by deal would indicate, generally about 68% of the after repair value is where our loan limit caps out. And within that, again, would be a percentage of that going towards purchase price, a percentage of that going towards rehab budget, as well as a component with some prepaid interest to have some of the payments included within the loan amount.
There you go. Tell us about interest rates and how an investor or client might be affected on that.
Sure. Those loans we're originating with a 5-year term. That term has no prepayment penalty, so it's suitable for the project that investor is purchasing with the intent to resell quickly or as quickly as market allows. It also gives you far more flexibility than some of the shorter term loans that other hard money lenders have offered or are offering still. Whether it's a 6-month or a 9-month term, with this program, you avoid some of the extension fees that would come with that scenario. The interest rate for the loan program I'm describing is 10.99% annual. And among the closing costs with each of these loans, you would have a loan origination fee of 2.5%. So $100,000 would cost you $2,500 as a line item closing cost. Okay,
so the loan origin fee 2.5%, and we're looking for the 5-year for about 10.99. Can they get a lower interest rate if they pay down points, or if they do a shorter term, or does it?
Again, we've historically offered a 9-month term or a 6-month term at a slightly reduced interest rate. We've offered that at 9.99%. We have shifted away from those types of loans for the time being, just because it's the worst time, I think, to set somebody up to pay continuous extension fees. Mm-hmm. And for the difference in the interest rate between the two loans, again, the flexibility of the 5-year term, I think, is a much more conservative play given the times and uncertainty of the market conditions.
Yeah, absolutely. Because we're seeing a lot of hard money lenders 12, 13% at 6 months, and you're doing 9.99% for 5 years. That's amazing.
Correct. It's funny. We've been asked a few different times if we intended to increase our interest rates, because there's several others, as you mentioned, that have. And it just doesn't seem the right time to do that. We'd rather offer the same product we have, be maybe a little choosier about the loans we do, how the money is deployed, but do so responsibly.
So how do you qualify the value of a house? So me as a realtor, I'm taking clients to see homes all the time. So let's say that we find a home, it's we're putting an offer on it for $80,000, but the ARV or the after repair value, you know, we think it's 150. How do you determine what the ARV is?
Yeah, so we have we lend. I guess let me start by saying we lend statewide in the across the major metros, um, and we have assets on the ground in each market. People like yourself, Austin, usually real estate agents, what have you, that can validate an opinion, do a little bit of backtracking. But I'll say further myself personally. I've been a licensed real estate broker for 15 years, and I'm a member of the board in each of the markets we lend in.
Mm-hmm.
And so I'm pulling live comps when I'm presented with these, trying to make the same assumptions about a neighborhood as you are when you're presenting your clients with that house. So yeah, just trying to apply the data that's available, but doing it a live time. If I have an inbound call, I can, a lot of the times I can work through that while I've got the borrower on the phone or while I've got the broker on the phone. Um, you know, batting back and forth data that I'm seeing versus the comps that you've pulled, Austin, and what they tell you. So that's how we arrive at value on these. Eventually, it's validated by an appraisal. Through our process, we do order an appraisal on most of the loans that we originate. We do so for a couple reasons. One, it's helpful that we have a third party valuation in our file. But two, it's also a nice double check to make sure that the square footage measurements in the county appraisal district is actually in line with or close to what the measurements of the home are. And in a few instances where we do discover a discrepancy, that's information we need. It's information you should know and the buyer should know as well. And so it's just a nice set of checks and balances to include that in the process. But on the front end, we're able to get a read on these, give you an accurate set of figures that rarely do we have an appraisal come back that's a surprise in one direction or another.
Yeah, we see enough homes that we can generally get a pretty good idea before the appraiser comes out. Jennifer, Tell us a little bit about what you do and how can someone get started getting pre-approved for hard money loan with DJ Jordan Properties?
Well, I process the loans for DJ Jordan, and I work for the attorney's office. So I prepare the legal documents. My background is in title work, so it kind of fits. I have been in the real estate business since I was really young, one aspect of it or the other. So that's my job. And what they can do is contact me or they can contact Justin. Normally we start when they've already are working on a contract. Once we get a contract in, we start to ask them for information that's personal about themselves and, get a little loan application going. We set up a file. The good thing about that is with our return customers, once we have a file set up on them, it's a good long time before we need to update any information from them, like when their licenses expire or things like that. We do order credit on our borrowers, but we're not looking at their credit scores. We need to find out if they're in bankruptcy. We need to find out if there's any federal tax liens out there. So that never hurts their thing. We don't report to credit bureaus, so it's only for our information. And like I said, since we have that in our setup file, we don't ever need to do that again for a long while. So it's really easy to get things done. I also do inspections. I'm local here in Houston, so I'm close to most of the properties, unless they're south, northwest, northeast, then I'm kind of far. But doesn't matter. Right now with no traffic, Beltway is the way to go. Yeah. And no fees. But so I do a lot of the inspections for our rehab. So once they're completed, I go out and look, take pictures and stuff so we can do the draws. But that's what I do here. And they can call me. They can email me. They can call Justin. They can email Justin. One of us is always available. I take calls. Even when I look at the phone, I'm like, oh my gosh, it's 7 o'clock. Oh, well, hello. Yeah. So, it's like, I'll help them if they need help. But yeah, they can call either of us, give us the information that they're looking for. What we normally need is the address, what they're looking at for their project, how much they're talking about purchasing it for, and what the ARV is going to be, so we can figure out those numbers.
Do you recommend them waiting until they find something, or do you recommend them going ahead and getting pre-qualified with you before they start the process?
I'll let, we do a little bit of both, but I'll let Justin take that instead because he handles that on that end more than I do.
Yeah, and it's a good question. Everybody kind of has a different preference from one borrower to the next where they decide to involve us. I'm a fan of somebody reaching out early in the process just so that they're aware, so that they can hear, from me, from Jennifer, from a member of our team, how this process is going to go. We don't have a number of hoops we make them jump through immediately, though. We're not pressing them to fill out a loan application. We don't want to run a credit report unless we're processing a file for them.
Right.
And so it's kind of a balance we have to strike there. But I do prefer that we have some sort of contact with the borrower ahead of time so that we know, what, or we can set for them what the expectation on their end will be as they move through each step of the transaction. It is relatively easy for us to process these files quickly. And as I mentioned, the qualifying end of it, the most important part of determining where our loan amount is going to fall relies exclusively on the house. So one house to the next, or one deal to the next, our lending parameters might sound and look a little bit different. And so that's why, I guess, to the point of somebody waiting until they have it under contract to come to us, or waiting until they've identified a property that they're interested in before they come to us, that allows us to, specific to that property,
Right.
go ahead and qualify them for it, which is going to be, reliant on their cash. If I'm lending a percentage of the purchase price, well, they're going to have a, percentage of it that is a down payment. We can help them, with the expectation or, anticipation of closing costs related to that particular deal. And so that, when somebody presents me with the information Jennifer mentioned a minute ago, with an address, a purchase price, a rehab budget, we can use that information to create a formula that equates to how much cash of their own they'll have involved in the deal and how much cash they'll need to show as a proof of funds in order for us to qualify them for the loan.
So can we role play maybe a real scenario? So let's say that I have an investor client. We're looking in LaPorte. Okay, so I live in Pasadena, Deer Park, LaPorte, and we find a house that is, we're going to put an offer on it for $80,000. We believe that after repairs are done, we believe that the home is worth $140,000. And we know that the house needs about $30,000 worth of work. So that's going to put us in at 110. So what would this person need to have in his or her pocket in order to move forward with this deal? And what would that process look like?
Yeah. So what we would look at, again, we would start with the after repair value. And in that case, you said it was going to be 140,000. And so in order to, figure out how much of each of these loan components is going to go into that, we do immediately, say, okay, the 140 is actually 140, all good, which means, at 68% of that amount, is where my loan amount is going to cap out. So that's a $95,000 loan, 95.2 if we're being precise here. So within that loan amount of 95,000, there's a percentage of that that's going to be directed towards the purchase price, a percentage of that that's going to be directed towards rehab funds, and a certain portion of it is going to be directed towards maintaining a few months of prepaid interest on the front end of the deal. This is more an art than a science. It's a spreadsheet that we maintain, and again, specific to these deals. But if we do start factoring in, payments for a loan like this, what we've got is basically 3 months of interest. And payments, what have you, for a $95,000 loan. About $2,800 of the loan is going to go towards prepaid interest. About $24,000 of the loan is going to go towards the rehab piece, and the down payment requirement then being a byproduct of those two calculations. It ends up with us funding about 86% of the purchase price in this particular instance. So then we take it a step further. If I'm funding 86% of the purchase price, buyer comes up with a 14% down payment plus closing costs.
Okay, so 14% down payment.
I'm sorry, I didn't mean to cut you off. What were you
So
saying?
you said a 14% down payment plus closing costs is what a buyer should. Okay.
Yep.
Awesome. Okay. Clear, very clear, easy to understand, and it's an area that we'll see a lot.
I'd like to add something to what Justin said earlier. We are prepared to be able to do things pretty quickly. And a lot of times, we have some time, whatever the contract closing date is. But once we've got our file established for a borrower and we've done closings with them before, we really can get those things out pretty quick. So, I mean, we like to have the time to take, but once we're doing a repeat borrower, we can get things out in a week or less to close.
Well, absolutely.
As long as there's no title issues, obviously.
Well, we know in the real estate world, we use the term time kills deals. And we have had clients work with lenders that were slow to responded by email only, and it took 3 days to get a response. And we end up begging our clients to fire those lenders in those types of situations. So be able to have a relationship with the lender that's going to answer the phone, that's going to respond quickly. We're going to make sure that we're not going to miss any opportunities to take advantage of a really, really great deal. And also there's safety in numbers too. So I may come up with an ARV, and a lot of times I'm right, but I don't bat 1,000 when it comes to my assessments of properties. And so having your eyes on that, and then finally an appraiser, if somebody makes a mistake, there's going to be somebody else to help and to ensure that our client's not going to lose any money. We want our clients to get good deals because we want them to do multiple deals, because that's what keeps us in business, and that's what keeps the relationship together. So, well, we appreciate your time. Is there anything else that you wanted to add for this afternoon?
No, I think that pretty well encapsulates what we're doing. Happy to serve as a resource if the occasion arises.
Yep, I hope we get to work with y'all.
Yeah, absolutely, Jennifer. We appreciate your time and looking forward to sending you some business and helping our clients make some money. And especially during this crazy time, it's a really good opportunity to get into real estate investing. So we appreciate it.
Yep.
All right, everybody. Thanks for checking us out, tuning in. If you have any questions, let me know, Austin Jones, and we'll see you next time. Thanks.